class on the introduction to Japanese candlesticks. Now, tonight's class is sponsored by an amazingly great Forex and CFD broker called UBCFX. And they have many benefits for trading on their platform. But one of the biggest benefits is their education center. And they offer outstanding education for all of their traders, like sponsoring tonight's webinar. They also offer their VIP credit card. You get an innovative platforms. You get an Activate platform. You get the Sirix Web Trader, or Mobile Trader, and you can get the Sirix Station. So you decide how advanced your computer or what type of computer trading you'd like to do. And you also get a swap-free account, 24/6 customer service, and spreads as low as 0 pips. You can trade all the major assets on their platform, and you can follow along using social traders to see how all the major traders on their platform are doing. And if you want to copy their position, you can copy right along with them, or just watch all the action that's happening on the platform. Now, like I said, you can use their Sirix Web Trader, which is their dynamic platform with a one-click trading, works on any browser or operating system. It's got built-in an electronics calendar, economics calendar, and advanced charts. Or you can use their Activate trading platform, which has pre-programmed analytics tools, direct news feeds directly to the platform, trailing stop losses, and one-click execution. Then, of course, there's the Sirix Station, which has got superior analysis tools. And then, of course, you can trade on your mobile device. So in other words, you can trade any which way you wish. You get the most advanced trading tools. They have special accounts. They have great signals, advanced education, and a wide variety of trading platforms. You also have a multitude of accounts. You pick and choose the type of account that fits your trading style and your needs. It's up to you. Now, UBCFX is a regulated provider, and therefore I'm required to give you a risk warning. So I'll read the first paragraph, and I'd appreciate if you could read the rest along with us on the screen. Trading in the financial markets may result in the loss of your deposited funds. Please ensure you fully understand the risk and seek independent advice if necessary. UBCFX provides an execution-only service, and therefore any market analysis, opinion, commentary, or other information which is provided during this webinar is for educational purposes only and is not intended to be a personal recommendation or construed as advice. So make sure when you go to UBCFX, and you can go over there right now by going to www.ubcfx and open a demo account. And you can visit their education center when there and see how big their library is, how broad their webinar program is, everything you need to know. Now, tonight's class is being recorded, and you can access a recorded version of tonight's class by using the same link you used to attend tonight's class in about 24 hours. Or down the road, an edited version of tonight's class will be available on investing.com under the Education tab, and then look for webinars on demand. And in fact, you can see all of our webinars there. Everything that's been given in the past. So you can go there and look up and see every webinar or watch any webinar you'd like to watch. So let's get started talking about Japanese candlesticks. Now tonight, I'm going to use the term security when referring to any tradable financial instrument. This includes stocks, bonds, commodities, futures, indices, mutual funds, even cryptocurrencies. Now, while I may imply a specific investment product, like I might say, oh, this is how you might trade Bitcoin, or this is how you might use for the euro US dollar. I am just trying to come up with more words so it's not so boring saying security, security, security. So if I may say shares, which implies an equity, these investment concepts will work for any publicly traded financial instrument in which an open market exists. Similarly, I intermix the term investing and trading. Now, most of us here tonight are classified as traders. Typically, an investor is looking to take a long-term position, while a trader takes much shorter-term positions. And in fact, investors very rarely use charts like candlestick charts and technical analysis because they're looking at the overall long-term growth, whether they're looking for investments or investment stocks or value stocks or high yield stocks. They're more concerned with the fundamentals and the overall economic growth. We would be more concerned with the dollar going up over time based on Federal Reserve interest rates than a short-term blip on a candle and what one candle is telling next to the next candle. But in either case, the basic concepts and techniques presented in this class are equally adept. Now, candlesticks fall into two categories because they are candlestick charts. And anything we do on a chart falls in the category of technical analysis. But also reading candlesticks is part of technical analysis. Now, you're sitting out there in the audience tonight and you're saying, well, should I learn to buy today? Will this tell me what to buy today? What will the prices be tomorrow, next week, or next year? Wouldn't investing be easy if we knew the answers to these seemingly simple questions? Alas, if you are attending this class in the hopes that technical analysis has the answer to these questions, I'm afraid I have to disappoint you early. Candlesticks will not help you with those information. However, if you're attending this webinar with the hopes that technical analysis and using candlesticks will improve your trading, I have good news for you, it will. Now, candlesticks are a form of charting that was developed in the 17th century. It's moved to the Western world in the 1900s. And when I started trading 40 years ago, there were a couple of traders that used candlesticks, but everything was hand charting. And candlesticks quite a bit of time to draw the body, the wicks, and color them in. And when you're hand charting, you need expediency because there was no computers, and like we traded agriculturals, and you're looking for 10 different prices in just cattle alone, and you're hand charting, so you got to get them on your charts pretty quickly. There weren't computers, and there wasn't any online. There was no internet, and so it was an old world. But with the growth of online trading, especially, candlesticks and candlestick charting has become the main use of online traders. With the development of online trading and with the fast development of HTML and Java charts, traders came to move to these very quickly. And because they look more sophisticated, and lots of traders would come out there and say, oh, I can see reds and I can see greens. Oh, all those greens are going to tell me I should buy, and all those reds are going to tell me I should sell. Well, candlesticks are a lot more than that. But unfortunately, everybody gets attracted to the easy, the brights, the flashing colors, and the flashing lights. But candlesticks are great charts, and they're a great charting system if you understand how to use them and how to read them. Now, each candlestick represents a data set of the complete price action during the selected time frame. The time frame could be anything from a few minutes to a month. Now, to draw a candle on a candlestick, first we take and we select the time period we wish our charts to be in. Whether we're using a 15-minute chart or 1 hour chart or a 1 day chart or a 1 week chart. At the open of that period, we draw a line across. At the close of that period, and if we're using a 1 hour chart, we draw a line across at the close. We put a dot at the highest price that asset reached in that 1 hour period and a dot at the lowest point. We then connect the dots to the line, the dashes, and we connect the dashes together. This area here, in this case we color in red, and I'll explain to you why in a second, is called the body of the candle. Now, if we stepped down from the open to the close, it's a bearish candle. If we step up from the open to the close, it's a greenish candle. And that tells us who was in control of the markets. So after we draw the whole thing on the chart, we then color in this body based on the fact that it's bearish or bullish. Now, in today's market, we tend to use reds and greens, just like we do on the charts, just like we do on the platforms, the things going up and things going down. We you know, when we see numbers flashing, when we see prices changing, we understand reds and greens. Now, when I started trading and we were hand charting, we were using pencils to write charts. So when it was a bearish session, or what we're using as a red candle today, we would use the side of the pencil and just fill in the body, and it would be black. When we would have a bullish session or a bullish time frame, we just wouldn't color in the body, so we'd have a white candle. Today, black has been replaced with red. White's been replaced with green. And the reason I'm telling you this is lots of literature you read, lots of material you're going to see, lots of information on candlesticks, because it hasn't all been updated, and all the graphics out there haven't all been changed, because, you know, somebody who wrote a book 15 years ago, the book is still valid. It just has some things that are outdated. So a lot of times you'll hear people referring to a white candle or a black candle. Or we have patterns that are called 3 black crows. They've never been changed. The name of the pattern has never been changed because it's a name. So it really technically could be 3 green crows, and we have 3 black soldiers, and we have 3, you know. Okay, so I just want you to know. Now, so each candle shows us the open, the high, the low, and the close. That's all that a candle does. And if you know anything about charting, you know a bar chart shows you the same thing: open, high, low, and close. They just give you simple, different visual images of price. Now, I've got a little video for you that I'm going to share with you that's going to show you the step-by-step. And I'm going to try to do it a new way tonight. Hopefully it's going to work. If it doesn't, I've got the old way stored for you, but I'm going to try to do it a different way. So hold on a second. We're going to experiment together.
Get to know the main chart pattern. You probably think that financial analysis is complicated. But it actually comes down to 2 simple things: reading charts and reading news. There are many types of charts. The Japanese candlestick, or simply candlestick, are the most popular ones. Such a chart consists of red and green candlesticks, or candles, lined one after another. Each candle gives you detailed information about the price movement within a specified time interval. In fact, Japanese candlesticks are the best way to visualize the ups and downs of a price, so that you can spot potential opportunities to buy or sell. Let's take a more detailed look. Every candle consists of a body and 1 or 2 tails called shadows sticking out of it. The body indicates the range between the open and close price for a specific time frame, and the shadows represent the highest and lowest price levels reached for the set interval. Japanese candlestick charts are easy to read. A red candle shows that the price is going down, and a green one represents an increasing price. If you're looking at a 10-minute chart, each candle represents a 10-minute time interval. We see a green candle when the open price is lower than the close price. If the price closes lower than it opened, then the candle is red, As simple as that. What kind of signals does a candlestick chart provide? It's no surprise that candlestick charts are so popular. They're excellent for spotting market turning points. By looking at the patterns that candles create, you could often guess if a certain market is about to continue in its current direction or reverse it. Patterns that show that the market could change direction are called reversal patterns. They could be bearish, ones that indicate the change from an uptrend to a downtrend that should be perceived as a signal to sell. Or bullish, these show that a price that has been decreasing is likely to start going up and we should buy. Let's see the most popular candlestick patterns which encourage you to buy. Bullish engulfing. The bullish engulfing consists of a red candle followed by a bigger green one, which fully engulfs the red candle. The pattern is an indication for a market turning point. In simple words, it's likely that the market may start going up and you can buy. The indication is even stronger if the green candlestick engulfs 2 or 3 red candles. Hammer. The name of this candle is pretty much self-explanatory. You'll recognize the hammer by its short body, lower shadow that is about 2 or 3 times the length of the body, and a shorter upper shadow, or no shadow at all. The hammer is usually a clear indication of a declining price reversing its direction and starting to go up, so you can start buying. But just to be safe, you can always wait for additional confirmation. Such confirmation is a green candle closing above the open of the hammer, for example. Morning doji star. This pattern appears when there is a slight market movement and consists of 3 candles, a red one, followed by a doji, followed by a green candle closing beyond the middle of the first candle. If the green candle is longer than the red one, the signal is even more reliable. Spotting the morning doji star is a signal to buy. Some chart patterns that mean you can sell. Bearish engulfing. This pattern is the opposite of bullish engulfing. The green candle is completely engulfed by a following red candle. When you spot it, you can sell, as the sellers on the market have possibly managed to overpower the buyers and the price direction could reverse. Dark cloud cover. The dark cloud cover appears before the price drops down. A long green candle is followed by a red one that opens at a new high and closes below the middle of the green candle. Keep in mind that when trading currencies, a second candle opening at a new high is rare, so the red candle usually opens at the close level of the green one. Once you see this pattern, you can go ahead and sell, or you can wait for another, smaller red candle to form and confirm the dark cloud cover. Shooting star. The shooting star is a red candlestick with a small body, long upper shadow and a short lower one. When it appears at the end of an uptrend, it shows you that you can sell, since the price, which has been rising up to that point, may start falling instead.
So, ladies and gentlemen, hopefully you enjoyed that. Now, I know that we went over a great deal of, I'm just trying to get the right screen up here for a whole second. We went over a lot of terms, doji, hammer, and different patterns, bullish engulfing, bearish engulfing in that video. There are some handouts on your screen. Okay, there's the candlestick cheat sheet, the number of candles explained, the second level candlestick patterns, and the top level candlestick patterns. Now, you can download these right now onto whatever device you're listening or attending the webinar with. And once you've downloaded, because once after this class is over, you can't access them in the recorded version. Okay. Now, these are standardized. These are not unique things that I came up with for you just in class. I put them together for you so you could have them in easy manners, but you can find them in the internet. There are a total of 32 different patterns in candlesticks, which you have to kind of know. Or you don't have to know the terms, but you have to be able to recognize them. And it's important. So you have them in the cheat sheet and the handouts. So please click the download button and save them. Now, remember when I said you fill in the candles with red and black, red and green, or black and white. So this example I've had for you is in black and white. Okay. So the black is equal to the red, and it's a bearish signal. But there are 6 different stories that candlesticks tell in general, because we start at general levels and then we come down to actually trading levels. But the general levels tell us about the battle between the bulls and the bears and who controlled that segment of time. So like I said, if you're using a 1 hour chart, you're using a 1 hour candle. So it's who controlled that 1 hour of trading, or who controlled the 1 day if you're using a 1 day candle. Now, there are only 6 different interpretations. Number 1 tells you that the bulls were in control for most of that session and they dominate. Means you have a fairly large body of a candle and you have wicks going up and down. But because it closed higher than it opened, it's bullish. And because the wick, it closed pretty well close to the wick, it closed pretty close to the high. So that tells you the bears yanked a little bit somewhere, but they had no control, the bulls controlled. Number 2 is the exact opposite. That tells you the bears were in domination. Now, you can see some commonality between 3, 4, 5, and 6. The common point is they have small bodies. Okay. Number 3, we have equal-sized wicks on either side, but we have a small body. That indicates that neither side was in control. Okay. Period end, they pulled and they pushed and they pulled and pushed, but nobody got anywhere. 4, in the white example, tells you the bulls, and the black example tells you the bears, but still they had an equal sized body, so nobody can control. But since we have a very long wick going down, that tells us at some point the bears got a little burst of energy, but they weren't able to hold on to it. 5 is the exact opposite. 5 tells you the bulls were able to run up the price but couldn't hold it up. And then number 6 tells you we had lots of activity. If you imagine this is a tug of war, and one team's on one side of the river, the other team's on the other side of the river, and they're pulling back and forth, back and forth. Nobody's dominating, and they're yanking back and forth. But in number 6, the guys on the left side of the bank were able to pull all the way in and get some of the guys on the right side in, but the guys on the right side were able to pull back and pull some of the left guys, but they both ended up on the riverbanks. That's it. But that's just a general understanding of who's in control of the time period. But now they have the basic idea of what candlesticks indicate with their bodies and wicks. Let's talk about some simple, uncomplicated patterns. Okay. So we can break down these patterns into 3 different areas. Now, I didn't make up this chart. In fact, I think I got it from Forex Factory or FX Daily or something. Okay, the chart remains the same. The patterns don't change, and how many candles. They got cute and they named them Lonesome Cowboys, 2 for Tango, and 3 Musketeers. I call them singles, doubles, and triples. And all it is the singles require just 1 candlestick, and the candlestick tells you something. Number 2 requires 2 candlesticks, because candlesticks are all about where they appear in a trend and where they appear in relationship to the candle before and the candlestick after. And the more candlesticks that are involved, the more accurate the information is. So you have them on your sheet. So we've divided down to 2 levels. You have the 16 most important levels, and then the second levels, which are the next 16, because there's a total of 32 different types of patterns, starting out with funny things called bullish Hammurabis and Marabuzus and Dojis. These are the 3 you'll hear about the most. Doji is like a cross. Doji means that there was virtually no difference between the open and the close. Now, it used to be a firm definition on a doji that it had to be exactly the same. But that worked well years ago in the stock market. But it doesn't work well in gold or agricultures or CFDs or Forex, because they trade in such small increments, pips, which are 4 digits to the right. So if the euro opened at 135.412 and it closed at 135.413, it's such a small, tiny difference that a doji can have a slight little body, but a very, very slight, because it doesn't have to be exact. Okay, a Marubozu, which is what we see over here, you can notice right away something unique about a Marubozu. A Marubozu has no wicks, and that's a very important telltale sign, because that tells you that if it was a green candle, that there was no low and there was no high. That tells you from the second that time frame opened to the very close of that time frame, the bulls were in control. The bears never got an edge. And the exact opposite for the bearish. For everything that there is, there's a bullish and a bearish. And then the third common one is called a harami. Now, a harami I use quite often. Harami in Japanese means pregnant. So what it's saying is the harami is the first of your 2-part candles. It means the current candle, including its wicks, must be fully encompassed inside the body of the previous candle, just like a pregnant person or pregnant animal. The body of the newborn is completely inside, not down at her legs and coming out of her mouth. It's completely enclosed in the body of the parent. Now, these 3 candles happen often and are important to watch for. Then we go on to all types of other candles, and they're all important, especially the ones in the top 10. But remember, I was mentioning about greens and reds. So we still call 3 white soldiers, although it should be 3 green soldiers. And we call 3 black crows, even though it should be 3 red crows. But before you freak out, before you get lost in all this, okay, first of all, you don't have to remember the names of the candlesticks. You have to just remember the patterns. Okay, you have to know when you see these particular patterns develop what they're trying to tell you. Whether you remember it's called a Marubozu or a doji or a hammer, doesn't make a difference. You have to understand what they're trying to say. Then don't freak out about how do you spot these on your charts. Because in the day, it used to be quite difficult and time consuming to watch these, because many of them take place and they involve 2 or 3 candles, and they take place. If you're using a 1-hour candle, it means over a 3-hour period, and you don't want to sit there and keep watching and watching and watching. Now, it's also important to understand where these are appearing in a trend. You should always be aware where the candlestick is actually appearing. Like a doji that just happens to appear in the middle of a move doesn't tell you anything. When it happens to appear right on a trend line in a trend, it's much more important. And then we have probably the most classic pattern, which is called a bullish and bearish engulfing. A bullish engulfing is very important when you have a downtrend, because that's telling you that downtrend is not only over, it's going to move to an uptrend. A bullish engulfing or a bearish engulfing tells you just the opposite. And define it. It's exactly what it sounds like. Is the current candle engulfs at least the full body of the previous candle in the opposite direction, or more than one candlestick. So in other words, we can see here that this current candlestick fully engulfed this body and this body and this body. Is the price movement. Okay, so the move downward on this one candle wiped out all that climb upward. So this is telling you the bears have taken control of the market. Bullish engulfing is the exact opposite. Like I said, for each direction, there is a opposite pattern. And we go to all kinds of things, like I said on the handouts, tweezers, morning stars, evening stars. Okay. But let me pop up, because I know what's happening is now everybody's freaking out and saying, how the hell am I going to spend my time and find these and see these and then interpret them? I need to spend all my time looking for this stuff. So now when you go through the various candlestick patterns, either you're going to have to go to the trading battlefield with the newly acquired knowledge, or you want to shout, stop it. I am too confused with all these funny names and shapes. I can't remember any of these. Well, the fact is the world's become an easier place. Just like candlesticks have become more popular, finding them and interpreting them has become a lot easier. So let me pop some easy things up here for you on our screen. And we're going to go over here to investing.com. Okay. And this is just one place I'm going to show you. Investing.com, if you pick an asset and click on that asset, like I just did here with the Euro US dollar, it's going to open up the chart for the Euro US dollar. If I go to my drop-down menu and go to candlesticks and click on candlesticks, look at that. It put each candlestick that's happened onto my charts for the Euro US dollar and listed them down below. Now I can customize it and set it up and decide what time frames I'm interested, what type of patterns, how important I want those patterns. Because some patterns are level, are less important. Like a doji by itself is very unimportant. Where 3 black crows with 3 white soldiers is a very rare pattern. Okay. And we set these up and click on apply, and it's going to give us a list of them. It's going to show us when it's happening, what time frame it happened, whether it's actually been completed, how long ago it started to take place and completed. And we can see it right on the charts. You don't need a trade from these charts, but once you see it here, you just bring it over to whatever chart you're using. You don't have to track them down. And here we have a doji star bearish reversal signal, the medium reliability, and it happened at 12 o'clock this afternoon. Now, that's a little bit long ago for us to tell us anything, but it is Friday evening, so the markets are. But the second way is investing.com will allow you, if you just go up to the main navigation under candlesticks, you can open up their candlestick box scanner and set up all the assets you want to trade and you want to watch. What hours, what time frames you want to watch, whether you want to just see emerging patterns or completed patterns, bullish or bearish, what level, put in the assets you want to watch, and then click on apply, and it's going to keep you abreast about all of them that are coming up. So we can see that if you're trading Ethereum, that right now, right this second, we have 3 black crow pattern developing. It's a bearish pattern. It's telling us that the advising is to trade down. Okay. If we click open on the box, it's going to show us what the pattern means. It's going to explain to us. And we can then go look at it on the charts. We can also see completed patterns. So we also have for here for Ripple, on a 1 hour chart, we have a 3 outside up that has just completed, and it's showing that Ripple is climbing. We have a morning star in Ripple Bitcoin. Okay, and so this is set up our life pretty easy. Okay, we can go back one step farther. If you're using TradingView or a lot of the private charting services, if you just go up here to indicators and go to our scripts, we can scroll down and look for a script that defines the candlesticks. And I clicked on it twice, so let's get rid of one of these. And all of a sudden now it's putting on all the candlestick patterns. So we're looking at gold in a 1 hour chart, and it's showing us right now we have a bullish engulfing that just developed right here on the gold chart. And yes, it's a lot to look at the moment because we haven't formatted, but if you go down here to the format, we can pick out every type of candlestick pattern we want to see, what colors we want it in, how we want it described, where we want to describe, and just save it. And then it'll just put on the candlesticks we're looking for, the ones we want to trade. And so we can limit it just down to the ones we want to trade, how we want to see it, what colors we want them in, and see what's going down. But we can see this bullish engulfing one, this bearish engulfing right here. And we can see that the price of gold is still trending down after that bullish engulfing. And it's just that easy. So we have easy ways. There's all kinds of scanners out there that you can download and apps you can download that'll find the patterns for you, tell you what they are. They're not going to tell you what to trade, but they will show you, help you find the patterns, and you can put them right on your own charts. And today our charts also, actually, let me get this off of here. Our charts let us set up the candles, customize them any which way we want. Let's go down to settings. And okay, and we can open up our settings chart. We can pick the colors we want to see, whether we want to see borders, everything we want to do. And like I said, with candlesticks, it doesn't matter if you decide you want to use pink and orange, as long as you know which ones are bullish and bearish, you're perfectly fine. Okay. You can put the borders everywhere you want. You can set the scales up you want to see them on. You set the backgrounds and set up the charts you want. So if you decide you want your candles in yellow and purple, because you like yellow and purple, as long as you know which one are your bullish and which one are your bearish, you're perfectly fine. So let's set it back to red and green. Okay. Now you can see many, many uses for candlesticks. Candlesticks will help you see and identify trends very, very easily. You'll see patterns. You'll see how they react to support and resistance. Candlesticks, you can see the development of price patterns in your candles. Like here, we can see the descending triangle, the falling wedge develop. Okay, you can see very much in here on how the price is acting within an uptrend and a downtrend line. You can identify with candlesticks very, very easily. So I've got another video that I'm going to try to show you that I did earlier, that I've used some price action to show you how you might want to use. How you might want to use candlesticks in your everyday trading. So let me share that with you.
Show you candle sizes and shapes, which is a very powerful price action technique. Here we have the Kiwi dollar. So if you've watched our other videos, we always want to identify key levels first. And as you can see, we have a level of support here where price hit and reversed from. And now we are back here again. Now, here's a very key point you need to know in order to spot high probability reversal trades. We want to see candles getting smaller and smaller as they approach a level of support or resistance, because it shows that price is losing momentum. Very key point. You want price to be losing momentum and slowing down as it approaches key levels. Now, as price approaches this level of support, look at how the candles behave. As you can see, we have a big candle, followed by a smaller candle, followed by an even smaller candle, another smaller candle, and then a smaller long wick candle rejecting support. And then finally, an even smaller green candle that is also a doji and also an inside bar, which is a reversal candle. And this results in a bounce upwards. So I'll show you this again on another pair. Here we have the Aussie dollar. This is a key level of support, as you can see from when price got here last, it hit and reversed upwards. So as price approaches this level again, we have a big candle, then a smaller candle, an even smaller candle, which is also rejecting support. And then we have this beautiful green long wick candle rejecting support. And then followed by another great inside bar candle rejecting support as well. And as you can see, price bounced upwards, which would have presented a great trade opportunity through the intraday time frames. So when approaching support, what these smaller and smaller candles show is that the sellers and people shorting the market are losing steam, meaning some sellers might be taking profit as they notice this level of support, which causes these smaller candles. So let's jump to another example. Here's the Kiwi yen. As you can see, we have a double top here before price tanked down, making this a key level of resistance. Now, as price approaches this level of resistance again, look at how the candles start acting. We have a big candle followed by a smaller candle, followed by a smaller red hanging candle, another hanging candle, and then a candle where the wick is rejecting this level of resistance before dropping down, which was another great trade opportunity. Here's the cat Swiss. Again, we have 3 rejections of this level before it reversed downwards, which makes this a key level of resistance. As price approaches this level again, we have a big green candle, a smaller green candle where the wick is also rejecting resistance, and then an even smaller candle, which is a red bearish candle. And as you can see, price reversed downwards. Now, here's a pro tip. Look for a candle color change at support or resistance, which can signal a possible trend change. I'll show you what I mean. So as price is moving upwards, notice all the green candles. Green candles represent bullish price action. As you can see, there's 8 green candles in a row before finally a red bearish candle appears. And the most important part is that it occurs right at resistance. And as you can see, price then reverses. Now, in the following examples, I'll show you price action you want to avoid. Here's the Aussie Kiwi. As we look to the left, this is a clear level of resistance. Now, look what happens when price approaches this area again. We have a small candle, but then the following candle is a large candle, which shows a gain of momentum. You do not want to see momentum gaining as it approaches these key levels, because if price doesn't slow down, there's a high chance it will break right through these levels. As you can see, there was no price action that signaled a reversal. So I'll show you this again on another pair. Here we have the dollar CAD. As you can see here, we have a double top and then price reversed, giving us resistance. Now look at what happens as price comes up here again. We have a small candle and then a massive engulfing candle, which shows that price is picking up speed and momentum as it approaches this level, showing that buyers are in control. Now this next candle here shows that people tried entering short, but that failed and price blew right through, which is a mistake that most beginner traders would make, as they would have seen this long wick candle and thought, oh, this is a great short. Be very careful when you see large candles approaching support or resistance levels. So let's jump to another example. Here's the dollar yen. You can see we have a double top here making this resistance. As price comes up and approaches this level, we have a big candle followed by a smaller candle that is rejecting this resistance, another candle rejecting resistance, and then finally a red candle also rejecting resistance before price reverses downwards. Now, here's a perfect example of momentum loss not occurring as it approaches this next level of support. So we look left and see 2 rejections of this level, making it a good level of support. But now, look at what happens when price approaches this level. We have a massive bearish red candle showing that momentum is picking up and that sellers are still in control. Here is another mistake beginner traders make as they see this small green candle, which is just some sellers taking profit, but it is then followed by another bearish candle before breaking right through, meaning that there was no buy opportunity at this level of support. Look at the difference between what a good reversal looks like with good price action versus what bad price action looks like.
So as you can see, candlesticks are a great way for us to analyze and see price action in the markets. Okay, regardless if you're going to trade simply from the patterns and positions of candles, or you're going to look at that in relationship to support and resistance and trend lines. But candlesticks should also always be used with other technical analysis tools. Because remember, each candlestick is just an observation and tells you market sentiment. Each candle of a candlestick chart is a reflection of this market sentiment. It's not just the standard patterns, but with keen observation, you can master the art of trading by looking at the charts without ever remembering the names or the patterns. So this is just a primer tonight. This is just an introductory course, an introductory webinar on to give you some general information about candlesticks. You've got your handouts. You've learned a little bit, but the fact is, until you learn to read these and practice with these, it's not something you're going to be able to start trading with overnight. Now, using these to help you interpret price action, and especially using them with support and resistance, can be a great step to start with. But you'll find that candlesticks will help you trade very well. If you only took 1 or 2 or 3 of the important patterns or important positions and mastered them, or start with one and just say, whenever I see 3 black crows or 3 white soldiers, I'm going to start looking to enter the market or get out of the market or make a trade. Okay, just look for whenever I see a Hammurabi or I see a Marabuzu. You don't have to learn. You need to know what the patterns tell you, or just whenever I see a bullish or bearish. The bullish and bearish engulfing are very critical patterns. So if you could just find those and start from there, start out small and eventually start using more and more candlesticks, but incorporate them into your trading system. But remember, it's all about money management and risk management. Just finding entry and exit points are not that important. And candlesticks can be helpful in determining the market volatility, where you would have to put your stop loss and your take profit points so that you can calculate your proper risk management and money management so that you can get high potential returns while minimizing your risk at all times. So thank you very much for joining us tonight. And remember, always look at the trends and the relationship of where the pattern is developing in conjunction with the current trends. Okay, and attend, we have class number 2 in candlesticks, we have class number 3 in candlesticks, and we'll teach you more and more how to read these and how to use these and let you keep moving forward using candlesticks. So remember, again, each candle on the chart is simply a reflection of market sentiment. So thank you very much for joining us. Thank you for supporting UBCFX and investing.com, and have a great weekend now.